And my guest today and our ongoing guest and colleague is mortgage broker Lee Hurst with Mortage Consultants Group.
Hello.
We're going to talk a little bit about what are the key indicators that drive rates. And ongoing, each time that we do an update, we are going to start with the interest rates for to that day. And we usually are going to be trying to do those going into a weekend. And then we're going to talk about the key changes and drivers of those rates in the preceding week. One of the things that I wanted to let you know is that I've been working with Lee for a long time. And one of the most common things as a real estate broker that I am finding is that our clients are being misled, but there's a lot of different factors that go into ultimately what the rate is. And particularly in my market niche, which is multifamily, many times the lenders who are less experienced are misquoting because there are some differences in rates.
Looking at today's interest rates, if you start in this first category, this is what we would call your vanilla rate, meaning it's an owner occupied, 20% down payment, perfect credit. All those indicators would indicate if we shop around and look at some of the best lenders, they're at about 6.5 with a little bit less than a point here. And so where people get confused is why can't you get a 6.5 rate for a non-owner occupied and a multi-unit property? Well, you can, but it would increase the points by a lot. So if you look at a typical spread between an owner occupied and a non-owner occupied one unit, it's about 0.3% higher because it's considered an investment property. And then if you throw no multi-unit factor in there, a 2 to 4 unit would add about another 0.8%. So if you're looking at today's current rates, 6.5 on an owner occupied loan, and then you want to compare that, well, if I go out and buy a 4-unit property to rent out, you're going to be about 0.5% higher than what you see published as a base owner occupied interest rate.
Lee, that's really kind of an important thing because what I am finding quite often, people will be working with a loan officer that's not familiar with the multifamily, and they're initially quoting them rates that would be more like for a conforming owner occupied property. And then later on, we get that surprise.
So I think if you just look up today's rates, and then if you're buying a fourplex, add 0.5%, you're going to be really in the ballpark. And we can look at rate trends. And so one of the better websites I've seen is Freddie Mac. So if you look up freddiemac.com, it'll have the ongoing, what I call the base rate for an owner occupied. Today, you're seeing 6.64, which is really close to that 6.5 that I was quoting on the interest rate. And so if you take that, add 0.5%, that's going to be a good barometer on where you're going to be at on a multi-unit investment property. This website's also good because you can see the trend. And so today we're at 6.64, but if you go back, they peaked out on Thursday, October 26th at 7.76. So you look from November, the first part of November to today, we've gone down a whole percent. So that's a great trend, and it does follow the trend that we're seeing with inflationary reports. And so you can also look up inflationary reports where this is what they were for 2023. We started in January at 6.64. Well, it came down in December all the way to 3.4%. And we actually got adjusted figures today that are showing that that's closer to 3.0%. So what the Fed's been doing has really been curbing inflation. It's been cut in half over this year in 2023. So if we keep seeing that trend continue, that's going to spur the Fed to start lowering interest rates, which they plan on doing this year.
So, on an ongoing basis, we're going to be sharing some of these websites and screens that help give us a better idea of what is driving these interest rates. So, for those people that haven't been following the whole inflation thing, that rate is right about 3%. And Lee, why don't you tell us a little bit about what the Fed's goals are in terms of where they're trying to head with this long-term inflation rate?
Sure. Well, the Feds have stated a goal of an inflation rate of 2%. And so they're not there yet. And that's why they haven't moved the rates down, because they're still hoping that we head there. And there's been conflicting economic data that has come out. So every week there's new economic data that came out. Last week there was the jobs number, and it was good. I mean, there were 300,000 new jobs starting. That was double what they expected, but that's an inflationary indicator. When there's more jobs, that can create inflation. So that made the market go, well, I don't know if we're going to lower rates or not. Now, this week and just today, they came out with a revised CPI number showing the core inflation rate went down to 3%. So that's good for interest rates. So there has been some conflicting economic data that is making the Fed's pause on when they're going to lower interest rate. The market is all betting on a drop in May at this point.
Yeah, that's really kind of interesting. And for somebody who's kind of casually following it, that's why there can be, so much volatility. One of the other things that we might want to talk about briefly, let's talk a little bit about how the T-bill, the 10-year T-bill affects those rates on an ongoing basis.
Absolutely. So one of the things we can look at is this 10-year Treasury yield, and it's probably the closest indicator you're going to find online to mortgage-backed securities, which is the exact thing that affects mortgage rates. But if you follow the 10-year Treasury yield, that's real. If it's going up, rates are going up. If it's going down, rates are going down.
So a lot of people really don't understand that. And I think for me, as you explained to me in the past, and it made a lot of sense, was this 10-year T-bill is a bet that these bond traders are making about whether the problems of the nation are getting better or worse. Is that a good way to explain it?
It is. And it's a flight to safety. And so if people are buying those Treasury bonds, they can lower that yield, and then we can offer lower rates. But if they're selling off their bonds, then the people that are selling those Treasury bonds have to raise the yield to attract those investors back, which ultimately increases mortgage rates.
So you see these situations where, like this last week, when the Fed left the rate unchanged, and you saw that there was actually a temporary spike. There could be a lot of reasons, but as this relates to what we're talking about, if these bond traders think that we are moving in the right direction long term, you're going to see that it's going to lead to the prices changing in those bonds and rates getting better. If they think that things are getting worse, then they start to want a little bit higher rate on those bonds. Is that correct?
Correct.
Explain it. So, as a mortgage professional, is there any other tools that you're able to use that the average common person isn't able to use to know when is the best time to lock in their rate and or the micro trends?
Well, there is, and I subscribe to a mortgage-backed security ticker, and what that does, it shows an ongoing minute-by-minute update on what mortgage-backed securities are doing. So that's what this chart is right here. You can see we're up 3 basis points. So when that's green, that's good. If this all of a sudden gets red and shows, let's say 25 basis points in red, I might need to lock your loan, because that could trigger mortgage lenders to reprice for the worst. So if we're in the green, maybe we just float and we watch this. And so sometimes we can save 1/8 or 1/4% by really tracking this mortgage-backed security ticker.
What's the best way for them to reach you?
Well, the one thing about the way I do business, and I know you've liked this, Ron, is that the only number I have is my cell phone that I give out. And so you can call or text me 7 days a week. It's 916-834-1282.
And I can tell you that in more than 20 years of working with Lee, generally speaking, when he says that you're qualified and this is the rate, he's kind of the no surprise guy. And that's why we continue to work well together. So appreciate you guys tuning in today. If you have not already subscribed to my YouTube channel, please look down below and hit the subscribe button. Again, thanks for tuning in, and we will talk with you soon.
All right. Thanks, everybody. Bye.